Okay, so here we are, picking back up with page 2 of this sample return. So line 38 is just a carryover from the previous page where we have our adjusted gross income. Okay, so we have line 38, adjusted gross income, 109,850. And then we don't have anyone that is blind or over age 65, so we don't need to worry about 39A. And then line 40 is our below the line deductions, the greater of itemized or the standard deduction. So it says here that we have total itemized deductions of $22,200. Oh, I cannot remember what the standard deduction is for head of household. To compare it, I want to say it's somewhere in the $10,000 range, but in any event, it is much less than $22,200. But that's what you would do, is compare the greater of standard or the itemized deduction. So let's take a look at her itemized deductions, which of course are going to be reported on Schedule A. So if we look at Schedule A, you can see we have the taxpayer's name and her social security number. Our first section up here is medical and dental expenses. So she had her medical and dental expenses of $4,300. What exactly does that include? So she has expenses incurred on her behalf for her of $5,000, and she also paid $800 for her dependent Jason, which gives us $5,800. Then she received a reimbursement from her health insurance company of $1,500, which gives us $4,300 of potentially eligible medical expenses. Note that she does not get to deduct the medical expenses that she paid for, forgot who it was, a friend from work. Okay, she paid $5,000 for a friend from work. She doesn't get to deduct those because that's not a dependent. So she has potentially $4,300 of expenses. But now if you can see here, line 2 says enter the amount from 1040 line 38, which is our adjusted gross income, $109,850. To deduct medical expenses, you only get to deduct your expenses if they are in excess of 10% of your adjusted gross income. And as you can see, line 3 says multiply line 2 by 10%. 10% of $109,850 is $10,985. Since $4,300 is not in excess of $10,985, her deductible medical expenses are 0. And you can see right here, subtract line 3 from line 1. If line 3 is more than line 1, enter 0. And then we have our state. Next section is our taxes. She's going to deduct the greater of for income taxes or her general sales tax. It says in here that the number from the sales tax table is $994. So in the back of your book, there's an appendix. And in the appendix, one of the things that's in there are something called sales tax tables. This means if you don't keep up your receipts every time you go to Walmart, which very, very, very few people do, you can still deduct sales tax without any receipts. The IRS basically says, where do you live, how many dependents do you have, how many people are in your family. Okay, you can deduct $994 of sales tax without any receipts. That's basically where she went, is this sales tax table. Very, very useful in states that don't have an income tax, like Texas. And then so we're going to take the greater of her sales tax or her state income tax. So our first question is, okay, well, how much income taxes did she actually pay? Great, okay. So it says here that she paid, let's see, how much withholding did she have? So state income taxes can be paid either 1, through withholding in her paycheck, 2, through additional estimated payments that are made throughout the year. So this is when she writes a check from her check account and sends it to the IRS during the year because she knows what is withheld is not going to be enough money. I do this every quarter in my family because we have our own business and we have to make these quarterly tax payments. If we didn't, at the end of the year, we would owe a lot of money. In addition, if you do not make estimated payments throughout the year, you can be subject to an additional penalty for not making estimated payments. Now, for the most part, you guys have never seen that because your employer withholds your income taxes for you. And that's considered an estimated payment, basically. So she knows her withholding's not going to be enough, so she makes additional payments during the year. It says here that she has $3,100 of state income taxes that are withheld from her paycheck, and she makes additional estimated payments of $1,000, which gets us total income taxes of $4,100. I see this every semester. Note, this is only state income taxes. You cannot deduct federal income taxes. Only state income taxes. So this $4,100 is her federal withholding of $3,100 plus $1,000 of estimated payments, which gets us a total of $4,100. Next category is real estate taxes. All right? So it says in the facts that she has property taxes of $3,200 on her residence and $1,100 on her car. So you can see here, $3,200 in line 6 for real estate taxes and $1,100 for personal property taxes. Note that in the state of Texas, we don't really have personal property taxes unless you own a business. So that gets us total, well, there's no total right here. So next category is our home mortgage interest. It says here in the facts that she paid $7,800 of mortgage on her residence to People's Bank. There we go, $7,800. Next category is charitable contributions, line 16 through 19. Now we're going to talk more in chapter 10 on the rules and limits for charitable contributions, but you don't need to worry about those limits for purposes of this return or your sample return. They're not going to come into play. They're not actually relevant for the facts that you have in your sample return assignment. So you don't need to worry about that. So if we look at her charitable contributions, let's see, it says that she has $4,500 to First Presbyterian Church and $1,500 to the American Red Cross, which is $6,000 total of charitable contributions, which will be entered in line 16, gifts by cash or check. Okay? She doesn't have any casualty or theft losses, and she doesn't have any miscellaneous itemized deductions down here in this category, which are largely subject to that 2% floor. Which means that our total itemized deductions for Roberta are $22,200, which carries to line 10, Form 1040, line 40, which we were just looking at on page 2. Now, if you're looking at the facts, she has some other payments on here that she makes that are not actually deductible anywhere. So, for example, she has a $1,000 ticket for parking in a handicap space. Not deductible. Attorney's fees of $500 for contesting the ticket. Not deductible. A contribution of $250 to the campaign of the candidate for governor. Not deductible. Okay? So, now, the next category on here is line 41, which is basically just our AGI minus our itemized deductions. Then we get to line 42, which is our exemptions. Multiply 4050, which remember is the exemption amount in 2016, by the number on line 6D. Remember, we talked about line 6D. Line 6D is the total of the taxpayer exemption, their spouse's exemption if they're married filing jointly, and their dependency exemptions, which here, line 60, is 3. So we're going to take 4050 times 3 and enter that number right here on line 42, which is 12,150. We're going to subtract that out from our 87,650, which gets us 75,500. Now, line 43 is our taxable income, right? 75,500 is our taxable income. Line 44 is our tax, calculation of our tax. Now remember, I said that we have both qualified dividends and long-term capital gains, which are subject to a preferential rate. So how do we know what rate she's going to be in? So if your ordinary income rate is in the highest tax bracket, which is 39.6%, you're taxed at 20%. If your ordinary income is taxed at 15% or below, you're going to be taxed for qualified preferential income for capital gains and dividends at 0%. I can tell you right now, she is right there in the middle. 75,500 is not going to be in that 15% bracket or below, and it is not going to be in the highest bracket of 39.6%, which probably doesn't start until about $300,000. If you're curious, you can look at the appendix in your book. It basically shows out the tax tables for you, and those tax tables basically tell you what percentage or what bracket you would be in for ordinary income, which of course is dependent upon your filing status. So now let's talk about how you actually calculate this. So we have 1,800. So we have our 1,800 for our dividends plus $3,500 for our capital gains, which gets us $5,300 times our 15% preferential rates, which gets us a tax of $795, which is our preferential rate. All right, now we have to calculate our tax on our ordinary income. So we have to take the difference of $75,500, which is our taxable income, minus $795, minus $5,300, which is our taxable income that is subject to this 15% rate, which gets us a $70,200. This number is the number you want to take through the 2016 tax tables, which are in D2L, or you can look it up on the IRS website. With these tax tables, we will use the table for the taxpayer that has 70,000, I believe it's 70,000 to 70,500 or something of income. And then you'll look at the filing status of the taxpayer, which is head of household, which will give you a total tax of $11,854. So this is our tax on ordinary income. So her total tax is going to be $11,854, which is our tax on ordinary income, plus $795, which is our tax on preferential income. So this total up here on the board of $12,649 is this number plus this number, okay? And you can see that 12,649 carries through to line 56, which is a total column. 12,649, this is our total column for total tax. Now we get down here to line 64 and 65. This is where we enter what payments we have made. So she has made payments for her federal income taxes in 2 ways, through withholding and through additional estimated payments. So she had $9,000 of federal income tax, not state, withheld, and she had $3,800 of additional estimated payments, which means she made total payments to the IRS of $12,800. we subtract our total payments from our total liability, you can see that she has a refund of $151. Okay, and that is it for our sample return.